Money has a strange way of teaching lessons. The amount you invest often changes not only the results you see, but also the emotions you feel along the way. Many people think that investing is only for the wealthy, that you need huge amounts to see any difference. But the truth is that whether you put in $1,000 or $10,000, both paths can reveal a lot about growth, risk, and discipline. The question is, how does that difference in starting capital change what you walk away with after 1 year? Let us step through this carefully, comparing the journey of investing $1,000 against investing $10,000. When you look at the numbers side by side, the first thing that stands out is scale. $10,000 is simply 10 times bigger than $1,000. But the growth rate, whether it is in a savings account, a stock market fund, or any other vehicle, remained. The difference is that 7% of 1,000 is 70, while 7% of 10,000 is 700. Same percentage, very different outcome. This is the basic math of compounding, and yet, it is also why the gap between investors grows so quickly over time. Imagine you place $1,000 in a high-yield savings account with a 5% annual interest rate. After 1 year, you have $1,050. Now take $10,000 and put it in the same account. After 1 year, you have $10,500. Both accounts grew 5%, but the second one rewarded you with $450 more. This gap may seem obvious, but it highlights something important. Bigger investments accelerate the compounding effect much faster, giving wealthier investors an advantage. But savings accounts are not where the real excitement lies. The stock market has historically delivered average returns of 7 to 10% annually. If you put $1,000 into a broad index fund like the S&P 500 and the market delivers 10%, you end with $1,100 after a year. If you had invested $10,000, you now have $11,000. The difference is that the smaller investor only made $100 in profit, while the larger one made $1,000. That difference can be life-changing if repeated year after year. Now let us look at something riskier, AI or technology stocks. These sectors can deliver wild swings. In a good year, they might return 20 or even 30%. In a bad year, they might lose 10 or more. If you put $1,000 into a tech stock that grows by 20%, you finish the year with $1,200. If you had $10,000 invested in the same stock, you finish with $12,000. Both are excellent gains, but the scale is what matters. The smaller investment gives you $200 in profit, while the larger one gives you $2,000. Here is where psychology begins to play a huge role. When you invest $1,000, every daily movement in the market feels smaller. If the stock dips 5%, you are down 50. That stings, but it is manageable. If you invest $10,000, the same dip costs you $500 in a single day. That is enough to make people panic. This is why larger investments often demand stronger discipline and emotional control. The numbers are bigger, and the temptation to sell out of fear or greed becomes more powerful. To make this clearer, let us build a scenario. Imagine two friends. One invests $1,000 in a diversified stock portfolio. The other invests $10,000 in the same mix of stocks. After 12 months, the portfolio delivers a solid 10% return. The first friend now has $1,100. The second has $11,000. Both did well, but one gained $100, while the other gained $1,000. The emotional satisfaction, the ability to reinvest, and the momentum to keep going all feel very different. The larger amount creates a snowball effect much faster. But let us not ignore the risks. What if the market falls by 10% that year? The $1,000 investment drops to $900, a loss of $100. Painful, but still recoverable with future gains. The $10,000 investment drops to $9,000. That is a loss of $1,000 in a single year. Suddenly, the difference is not just in profit, but in the weight of loss. Recovering from a big drop feels far more urgent, when more money is at stake. Now think about reinvestment. If you earn 100 from a 1,000 investment, reinvesting that profit into the next year gives you a small push. But if you earn 1,000 from 10,000, reinvesting makes the snowball much larger. By year 2, the gap widens even more. At an average of 10% annually, the 1,000 investment becomes about 1,210 after 2 years. The 10,000 becomes about 12,100. The smaller investor earned 210 in 2 years, while the larger earned 2,100, 10 times bigger again. That gap will never shrink. It only grows. This is the principle behind wealth inequality in investing. The more you have to start with, the more you can grow, even if you both earn the same rate of return. It is not about being smarter or luckier. It is about scale. That is why many financial experts push people to begin early, even with smaller amounts. Starting with 1,000 at age 20 can beat starting with 10,000 at age 30, because compounding time is often more powerful than compounding money. Another layer to consider is opportunity. With $1,000, your investment options are somewhat limited. You can buy index funds, some stocks, maybe experiment with fractional shares, or try a certificate of deposit. With 10,000, you gain access to more opportunities. Higher minimum investments, real estate crowdfunding, or even small business ventures. The size of your capital opens new doors that smaller investors cannot easily access. This is another reason the difference between 1,000 and 10,000 grows over time. Now let us play out 2 different examples. Case 1, 1,000 invested in a diversified fund. After 1 year, it grows to 1,100. The investor feels good but knows it will take years to see big changes. They reinvest and keep building slowly. Case 2, 10,000 invested in the same fund. After 1 year, it grows to 11,000. The investor feels a stronger sense of progress. They can reinvest that 1,000 gain, or they could use part of it for other opportunities. The growth feels tangible and the motivation is stronger. But what about riskier options? Suppose both investors choose a volatile stock that ends up growing by 30% in a year. The 1,000 becomes 1,300. The 10,000 becomes 13,000. The smaller investor walks away with 300 in profit. The larger one, 3,000. Both feel great, but the larger one feels like the year has been transformative. Flip the scenario. The stock loses 15%. The 1,000 shrinks to 850. The 10,000 shrinks to 8,500. The first investor lost 150. The second lost 1,500. The pain is magnified. The decision of whether to hold or sell becomes harder. This is the emotional cost of scale. The lesson here is that the difference between investing 1,000 and 10,000 is not just in outcome. It is in access, discipline, and psychology. The numbers get bigger, the opportunities expand, but so do the risks and the emotional weight. One person feels small losses and gains as lessons. The other feels them as serious decisions that affect financial stability. So what happens after 1 year? With safe options like savings accounts, the difference is small but clear. With average options like index funds, the difference is significant but steady. With high-risk options like tech or AI stocks, the difference becomes dramatic, either in large gains or painful losses. $1,000 can grow meaningfully, but 10,000 multiplies the impact across every scenario. The bigger takeaway is that both investments teach valuable lessons. The smaller investment builds habit. It proves to you that money grows when you place it in the right environment. The larger investment shows you the weight of scale, how discipline and patience become even more critical when bigger sums are involved. At the end of 12 months, 1,000 might turn into 1,100, while 10,000 might turn into 11,000. The percentage is the same, but the journey feels different. One path is about learning and consistency. The other is about momentum and scaling. Both are important, both are worth experiencing. If you are just starting out, remember this: it is not about the size of your first step, it is about taking that step. 1,000 today is better than waiting for 10,000 tomorrow. The habits you build now will prepare you for the larger amounts later. And when you do reach 10,000, you will know how to handle the emotions, the risks, and the opportunities with more confidence. The truth is simple. Whether you invest 1,000 or 10,000, the outcome depends on patience, consistency, and wise choices. Money grows when you let time and compounding work for you. 1 year is only the beginning. The real difference will show after 5, 10, or 20 years. But even within 1 year, you can already see how scale changes everything. And that is the powerful lesson in the more you invest, the more you stand to gain or lose. But the real win is not just in dollars, it is in knowledge, in discipline, and in preparing yourself for a future where money works for you instead of against you.